Welcome back to The Explainer. Today, we're unpacking what is honestly one of the most fascinating and definitely one of the most contradictory economic setups we have ever seen. We're talking about market crosscurrents, specifically navigating the macro-structural divide. Look, if you've been watching the markets lately and feeling a total sense of whiplash, trust me, you are not alone. Let's just jump right in and try to make sense of these opposing forces pulling at the global economy right now.
Let's kick things off with this massive, totally counterintuitive mystery. Right now, even as the stock market is literally inching toward fresh record highs, investors are just sitting on a staggering $5.6 trillion in cash. They're hoarding it in low-yielding bank deposits. $5.6 trillion. Just let that number sink in for a second. You really have to ask why. If the market is supposedly doing so incredibly well, why is so much wealth just safely parked on the sidelines?
Well, to answer that, we're looking at Section 1, the macrostructural divide, looking at reality versus sentiment.
The contrast here is honestly pretty stark. On one side, equities are absolutely crushing it. I mean, we've seen the Dow blow past 50,600, and the Nasdaq and S&P 500 have some serious momentum right now. But then you look at the other side, consumer sentiment is practically falling off a cliff. It seems completely irrational at first glance, right? That is, until you look a little closer at the data.
This is what we're calling the vibe gap, or the vibe session disconnect. The macro reality shows a clear upward trend. We're talking overall GDP growth and those stock market highs we just mentioned. But at the exact same time, consumer sentiment is plunging straight down. Now, traditional economic indicators tend to focus on the fact that the rate of inflation is slowing. But everyday consumers, they're reacting to the absolute shock of today's price levels when they compare them to their pre-2019 memory. It's a completely different perspective.
Which brings us to Section 2, navigating the noise, and exactly why people are so scared right now.
$2,189. That is the average monthly rent today. When your basic cost of shelter has surged to almost $2,200 a month, and you pair that with groceries jumping 25% since 2019, yeah, those high-level macro GDP numbers suddenly feel pretty meaningless, don't they? The sticker shock is incredibly real.
And honestly, it's not just the past price hikes causing all this anxiety. It's the very real expectation that things aren't going to stop. Headline PCE inflation expectations are stubbornly sticky right now, sitting at 3.9% year over year. That's up from 3.5% back in March, and it's largely being driven by these unexpected, really painful jumps in things like energy and gasoline.
Even the central bank is sounding the alarm here. Just look at this quote from Federal Reserve Governor Christopher Waller. He says flat out, inflation is not headed in the right direction. Strong headline and core inflation will likely force Fed officials to just hold rates steady. Think about that. When the folks actually controlling the interest rates are admitting the data is uncooperative, while it completely justifies the hesitation and fear we are seeing from everyday consumers and investors.
And this fear? It's translating into some very real economic demand destruction. Get this, 1 million prospective auto buyers have essentially vanished from the market since our 2019 baseline. They didn't just delay their purchases, they have been systematically erased. Stubborn inflation completely eroded real wages, high interest rates priced people out of financing, and persistently high gas prices basically finished the job. Auto executives thought we'd see a steady climb back to pre-pandemic volumes, but the new mathematical reality is signaling deep structural demand destruction.
Now add in the immense geopolitical noise, and you've got fuel on the fire. We're seeing extreme day-to-day volatility in oil, right? Prices swinging wildly from $90 a barrel on news of U.S. military strikes, then dropping again on truce optimism. But beneath all of that is a really wild situation known as the shadow fleet deception. U.S.-sanctioned Iranian vessels are literally sailing off the coast of Malaysia, obscuring their names with black paint and conducting illicit ship-to-ship crude oil transfers to launder the cargo's origin. It is a vital economic lifeline bypassing blockades, and it's a massive factor keeping these energy markets so incredibly volatile. So what's the fallout from all this? Let's move to Section 3, the cost of fear, otherwise known as the liquidity trap.
Look, it's human nature. When people are scared, they hoard cash. Like we saw earlier, $5.6 trillion, which is roughly 10% of Americans' liquid wealth, is just sitting in bank deposits right now. But we really have to ask the hard question today. Is cash actually the ultimate safe haven in an environment like this?
The data actually shows a resounding no. In fact, it reveals a truly staggering opportunity cost. Let's say you invested $5,000 every single year since 1980, but you kept it all in cash. You'd have about $350,000 today. Not bad, right? But look at the alternative. even with perfectly, absolutely awful market timing, like buying at the absolute peak right before every single market crash over 4 decades, you would still have $4.3 million. While cash earns nominal interest, its real return after taxes and inflation is practically zero. It's pretty wild to think about.
Okay, time to shift gears to Section 4, decoding the signal, focusing on the AI and infrastructure supercycle. So right now, we are smack in the middle of a heavily debated $5.7 trillion chip rally. The big question is, are we looking at a supercycle or a bubble? Now, the bubble case argues this is just a speculative frenzy, totally reminiscent of the late 90s dot-com boom, and it's tied to cyclical demands that are eventually going to normalize. But the supercycle case, it argues that compute power is actually becoming core utility infrastructure. Think railroads or the internet backbone. They're saying it's driven by exponential AI model growth and permanent supply constraints at the foundries.
And the reason the market looks so heavily weighted right now comes down to implementation lag. Step 1 is hardware and infrastructure investment. That is exactly why the top 20 best-performing S&P 500 stocks this year are all hardware companies. I mean, look at Micron doubling to a $1 trillion market cap in just 48 days. They are the ones laying down the physical tracks. Step 2, which is software and application monetization, naturally takes a lot longer. AI applications need cleaned, perfectly governed data before they can actually turn a real profit. That's why software companies are showing much more mixed results at the moment.
So, the crucial point here is figuring out where the immediate bottlenecks are in Step 1. And it turns out the biggest bottleneck is highly physical. Expanding AI data centers is actually being hindered by a severe shortage of contractors with electrical expertise. And you better believe Smart Capital is recognizing this immediately. Neocloud companies like Nebius, for example, are capturing a massive premium simply by bridging this physical computing capacity gap. They are securing multi-billion-dollar stakes from specialized funds purely because they are solving that physical hardware bottleneck.
But this infrastructure supercycle, it absolutely does not stop at data centers down here on Earth. Welcome to the space economy halo effect. Right at the absolute center, you have the catalyst, SpaceX, targeting a $2 trillion valuation and actively pushing into space-based AI data centers. Surrounding them are the pure-play, highly speculative companies riding that IPO buzz. But the outer ring? That is where the hidden value really lies. We're talking legacy defense contractors like Airbus and Lockheed Martin. They own the critical infrastructure right now, things like Ariane Group and ULA, and they stand to benefit from massive military space budgets without all that day-to-day stock volatility.
Which leads us perfectly into Section 5, our corporate repositioning tracker.
Because the smartest money isn't hiding, it's moving. These real-world corporate shifts are just incredible to watch. Ford just launched Ford Energy with a $2 billion investment to recycle EV batteries for stationary AI data centers. Their stock jumped 28% in 2 weeks on that single move. Crazy, right? Then you have ExxonMobil seeking geographic arbitrage, reincorporating in Texas for corporate-friendly business courts. Johnson & Johnson is completely offloading outright R&D for what they call open relationship biotech partnerships. And Chinese manufacturing? They're aggressively nearshoring to the Americas and Eastern Europe to evade Western tariffs and offset weak domestic demand. The global chessboard is literally moving at warp speed right now.
All right, let's bring it all together in Section 6, the capital allocation dilemma.
Everything we've talked about really comes down to this synthesis. On one hand, we have the noise. We've got sticky 3.9% PCE inflation, plunging consumer sentiment, the very real, very painful absolute price level shocks, and crazy geopolitical blockades. Honestly, it is completely understandable why everyday investors are hoarding $5.6 trillion in cash. But on the other hand, we have the signal. A $5.7 trillion hardware supercycle, generational IPOs in space infrastructure, and massive, rapid corporate realignment. In a regime of persistent inflation combined with a fast, once-in-a-generation technological disruption, keeping your money in liquid cash, it's really just an illusion of safety. Its actual purchasing power is slowly melting away.
And that leads us to our crucial final takeaway for today. When you look at this macrostructural divide, the greatest risk is not market timing. Like we saw on those charts earlier, even having perfectly awful timing vastly outperforms cash over the long run. No, the greatest risk is non-participation. Are you going to let the noise of the vibe gap sideline you, or are you going to capture the signal of the infrastructure supercycle? I'll leave you with that to think about. Thanks for joining me on this explainer, and I'll see you in the next one.